Kalshi doubles down on commodities, announcing a market expansion and a dedicated hub to accelerate product development. In a year when energy prices swing, farmland yields shift with weather, and investors crave clearer risk signals. This move matters. Prediction markets have been a steady undercurrent in hedging and discovery, yet mainstream participation remains uneven. A dedicated commodities hub signals a formal commitment to listing futures-style contracts on supply constraints, weather shocks, and price gaps. If pricing accuracy improves, firms can hedge better, speculators gain new venues, and regulators watch tighter correlations between markets and real-world events. The stakes feel urgent. Kalshi is expanding its product lineup to include more commodity-based events and establishing a dedicated hub that concentrates development, risk management tooling, and education. Instead of trading traditional futures on a regulated exchange, users would trade binary-style contracts promising a yes or no outcome by a settlement date. The hub aims to aggregate weather, supply disruption, energy, metals, and agricultural themes into a single platform. Think of it as an app store for real-world events where traders bet on price moves by specific dates. Regulators oversee the framework to ensure transparency, compliance, and fair access for all. Prediction markets have roots in finance and politics, with long-standing experiments in weather futures and election outcomes. Kalshi itself emerged as a regulated exchange, built on the idea that markets can aggregate diverse information into probabilities. The commodities space has traditionally relied on futures, options, swaps, and over-the-counter instruments, often with high fees and opaque access. A dedicated hub signals a shift toward practical education and productization, mirroring how fintech platforms metapack services into one ecosystem. Historically, commodity volatility has spiked around geopolitical shocks and supply shocks, making timely signals valuable for hedgers and speculators alike everywhere. Initial market reaction mixes curiosity with caution. Traders look for evidence that the hub can deliver liquid, reliable price signals for key benchmarks like crude, natural gas, copper, and corn. Early volume data for new products is patchy, but commentators note growing chatter on forums and social feeds about event risk and hedging efficiency. Some asset managers compare Kalshi to a weather derivatives concept crossed with a traditional exchange, predicting modest upticks in risk transfer and flexibility. In larger terms, the move reinforces a broader trend toward democratizing access to sophisticated markets, potentially lowering spreads and widening participation for investors. Early beneficiaries may include exchange operators, risk analytics firms, and data providers expanding coverage of commodities. Energy majors, agribusinesses, and miners could see new hedges and pricing signals under clearer terms. Retail traders gain frictionless access to event-driven contracts, although education and literacy remain gatekeepers. Sovereign wealth funds and family offices watch volumes and liquidity to avoid hidden slippage. Banks and brokers might reprice risk and adjust margins as forecasted events roll into a calendar. Startups building weather, supply chain, and geopolitical risk insights could monetize predictions, while incumbents reassess how to incorporate crowd insights into strategy today. Macro factors frame the Kalshi expansion. Global inflation continues to test central bank credibility, while energy and food supply shocks keep prices volatile. A dedicated hub could offer a more objective pricing mechanism during spikes, potentially reducing reliance on opaque over-the-counter bids. Geopolitical tensions around major corridors, sanctions on alternative suppliers, and climate policy shifts shape futures and weather-linked events. Investors watch currency regimes, interest rate paths, and debt loads as hedges accumulate. In a world of decarbonization, the demand for transparent risk signals across commodities rises, strengthening the case for reliable prediction markets in coming years. Smart money tracks convert this expansion into interpretive signals about risk appetite. Some hedge funds are testing Kalshi on limited product sets, measuring liquidity, slippage, and the robustness of settlement data. Pension funds and endowments prefer slow-paced, diversified exposure, yet they monitor hub announcements for potential overlays into existing commodity sleeves. Retail apps and robo-advisors start featuring educational modules, alerting users to hedge ratios and risk budgets. Banks may negotiate prime services for prediction contracts tied to commodity indices. The conversation shifts from novelty to a calibrated tool in portfolios as volumes gradually rise and data quality improves notably. Every new hub invites optimistic forecasts and risk lurking in the shadows. Over-reliance on crowd-driven signals could generate mispricings if data quality lags or if sentiment becomes crowded and self-reinforcing. Regulatory scrutiny could tighten or slow product approvals, constraining liquidity when volatility spikes. Settlement failures, counterparty risk, and operational glitches could erode trust. If macros shift, such as a rapid deflationary shock or a sudden energy price collapse, demand for credit and hedges could vanish overnight. Additionally, the commoditized nature of prediction markets could invite manipulation schemes and payoffs that misalign with real-world costs and market stability. Retail players should approach with education and discipline. Start by treating prediction contracts like options insurance rather than lottery tickets, setting strict risk budgets and exit rules. Use small allocations to test hedging concepts on weather or supply disruption events, then scale as liquidity builds. Seek educational content from the dedicated hub, compare pricing across venues, and track settlement reliability. Maintain diversification across asset classes and avoid overbetting on a single event. Leverage simple analogies from familiar markets such as airline fuel hedges or crop insurance to contextualize outcomes. Always confirm regulatory guidance and costs before committing capital for yourself. Looking ahead, Kalshi's Commodities Hub could reshape how buyers and sellers discover true price probabilities for energy, metals, and agri-goods. If the hub delivers reliable liquidity and transparent settlement data, risk pricing could tighten, and capital could flow more efficiently into hedges that align with real-world constraints. The growth path depends on education, regulatory clarity, and the pace of product development. Skeptics warn about overreach and misprices, while optimists point to a future where crowd insights complement traditional analysis today. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.